Hi everybody, it's Sebastian here from Wealth Depot. Thank you for joining our session today on investment bonds. Amidst the recent superannuation reforms, investment bonds have become increasingly popular as an effective tax planning and long-term investment approach, especially for high-income earners. Today, let's explore what investment bonds are, their features and benefits. Before looking further at today's presentation, I wish to advise you that information provided in this video is general in nature and does not take into account your personal circumstances. You should always seek professional advice before acting on any recommendations. So, what is an investment bond? Australian Securities Investment Commission defines an investment bond as an investment product offered by an insurance company or friendly society with similar features to a managed fund combined with an insurance policy. An insurance bond can provide significant tax benefits if they are invested over a long period of time, provided that withdrawal and contribution rules are not breached. This diagram summarizes the participating parties in an investment bond. First, you have the bond owner who makes the investment. The bond owner can be an individual, a company, a trust, or any other entity. An investment bond can also be jointly owned. Secondly, the bond owner has to nominate a life insured. The death of the life insured will trigger the maturity of the bond. The policy owner may be the same as the life insured, and in this case, the bond owner has to nominate a beneficiary who is entitled to receive the proceeds upon the death of the bond owner, who is also the life insured. Finally, ownership of an investment bond can be assigned or transferred to an individual or entity if certain conditions are met. If this is the case, the person you have assigned the bond to becomes the beneficial owner. Investment bonds are unique in the sense that, depending on the timing of your withdrawal, different tax rates will apply. Generally, the investment bond provider will pay all the tax due on the investment growth at the corporate tax rate of 30%. No tax is paid by the policy owner, except when the fund is redeemed within the first 10 years of commencement. If the fund is withdrawn within the first 8 years, the entire investment growth is counted towards the policy owner's assessable income. If the withdrawal is made in year 9, 2/3 of the growth component is assessable, and the assessable proportion, if withdrawing in year 10, is 1/3. After year 10, the policy owner receives the funds with no further tax obligations, and this is known as the 10-year rule. So how is the growth component calculated? The ATO has provided guidance in Taxation Ruling IT 2346. The growth component is calculated based on several variables, including the amount withdrawn from the policy, the surrender value of the policy before withdrawal, and the sum of earlier amounts paid. So let's examine how this formula works through the following case study. Alice is the life insured and policy owner of an investment bond that was commenced 4 years ago. The initial contribution was $200,000, and she has been paying a regular annual contribution of $25,000 per annum. The policy charges a 3% entry and management fee. So therefore, after 4 years, the bond has received $300,000 in contributions. The investment bond has had $9,000 in fees deducted and is now valued at $435,000. So Alice wishes to withdraw $120,000 from insurance bond in year 4. So the growth component is a calculation of the withdrawal amount divided by the current value, multiplied by the current value plus any previous withdrawal amounts, less contributions plus any previous growth components paid out. So in this certain case, the growth component is equal to $37,240. Thus, upon the redemption of $120,000 from her investment bond, Alice will have to include $37,240 in her assessable income. She will be entitled to a rebate of $11,172, being 30% times $37,240, due to the tax that has already been paid by the insurance provider. So that's how look after 8 years what Alice's position will be. So in 8 years, the bond has received now $400,000 in premiums, has had a previous growth per component calculated at $37,240, and now has an actual value of $375,000. So if Alice decides to withdraw a further $120,000, the growth component will be calculated as such. 120,000 divided by the current value, multiply the current value plus previous withdrawals, less 400,000 being the contributions to date, plus any growth component that has been paid out. So the current growth component for the period between year 4 and year 8 is $42,350. If Alice is redeeming the fund in year 9 though, only 2/3 of that growth component will be included in her assessable income, which will be $42,315 times 2/3, which is $28,210. Therefore, this amount will be added to Alice's assessable income, and Alice will be entitled to a rebate of $8,463. Besides the 10-year tax rule, a contribution rule also applies to investment bonds, which is known as the 125% rule. After your initial investment, you can contribute up to 125% of the amount contributed the previous bond year, without the obligation to restart the 10-year rule. However, it is important to note that if you skip contributions in a particular year, contributions in the subsequent years will restart the 10-year period. In addition, if you contribute more than 125% of the amount invested in the previous year, the 10-year period will also restart. This table indicates that upon an initial investment of $25,000 and making 125% contributions thereafter, you can invest up to $131,000 during a 10-year period. Out of this amount, only $25,000 is invested for the full 10 years. However, after 10 years, you can withdraw the whole investment, including the growth component, tax-free. However, as previously mentioned, contributions have to be monitored carefully. If you breach the 125% contribution rule, the 10-year period will restart from the year in which excess contributions are made. So, to sum up, what are the benefits of an investment bond? First, amidst upcoming superannuation reforms, which will tighten members' capability to contribute to super with lower annual caps, investment bonds can be an attractive solution, as members can contribute up to 125% of the amount invested in the previous year. Although the 30% tax rate for an investment bond is higher than the concessional tax rate of 50% inside super, investment bonds are still attractive for high-income earners who have a marginal tax rate of more than 30%. Furthermore, as an investment bond is a tax-paid investment, except when redemptions happen during the 10-year period, after 10 years, investors receive the capital investment and growth tax-free, which makes an investment bond an effective long-term tax planning tool. Thirdly, different from superannuation, where the preservation rules apply, you can access the funds invested in an investment bond at any time. However, it is important to be aware of the probable tax liability when redemptions happen before the end of year 10. Finally, with investment bonds, anyone can be nominated as the beneficiary, which differs from the nomination rules inside super. Thus, investment bonds can provide more freedom when it comes to estate planning. Despite all these benefits, investment bonds may not be a suitable option for everybody. So investors should consider their liquidity needs carefully before investing in an investment bond due to the 10-year rule. Overall, I hope you find today's session helpful. Thank you for your attention and look forward to seeing you again in our next strategy session. Good day.